What is a 20-pay, whole life insurance policy? Simply put, it is a whole life insurance policy that requires payments for just 20 years. Nonetheless, it will guarantee the death benefit for your lifetime. Not a bad deal. Here's why: you limit your payments. For many people, the prospect of paying for life insurance for the rest of their life is daunting. Who wants to do that? A limited pay product allows you to pay for a limited amount of years. Some products called for 10 years, others call for 20. Important note: that premium will be higher than one you would pay continuously for the life of the contract. But that makes sense. The company still has to cover its costs for the life of the contract. If you don't want to pay every year, they have to get some of that money up front in the form of a higher premium. What I like about this whole arrangement is that you still get your lifetime guarantee. Whole life insurance is, after all about guarantees. Guaranteed premium. Guaranteed death benefit. Guaranteed cash value. One might think that if you stop paying the premium, you would lose your guarantee. But that is not the case. The premium payment schedule is calculated to secure that guarantee for the lifetime of the contract. Short-term payment, long-term coverage. That is what limited pay whole life insurance is all about. Steve and David both have great answers to this question. In addition, a 20-pay policy typically is designed to accumulate cash, of which the cash can grow at a fixed or fluctuating, floating interest rate. This cash may or may not be designed to drive the policy. Some newer variations of whole life like no-lapse universal life or GULs or GIULs function like a funding agreement. If you pay your 20 payments as illustrated, they pay out coverage going to A100, A120, or your entire lifetime, irregardless of policy performance such as internal interest rates or internal charges. Some of these policies function like term to maturity. Considering that we are in a protracted low-interest rate environment, there are various options that you can choose. You can treat an insurance company like your personal financial risk trading partner, deciding along with your life insurance agent what types of risks you want to hedge. A 20-pay whole life policy is one where you pay premiums for at most 20 years. If you die before the 20 years are up, the policy pays off the face amount. After 20 years, no additional premiums are payable and the policy will pay the face amount either upon death or at some terminal age, usually age 100. Term insurance is significantly cheaper than any form of whole life insurance. The increased premium cost is used to provide cash surrender values. If you cancel your policy, you may receive some money back, but because of expenses related to issuing the policy, you are unlikely to get any money back the first few years a cash value policy is in force. Conventional whole life insurance matures, endows, finishes, etc. at age 95, 98, or some other age up there. Newer contracts may run to age 120. Can't be too careful. Conventional whole life has guaranteed level premiums for the life of the contract. 20-pay life is whole life, for life, but the premium are front-loaded. You pay higher premiums for the first 20 years so that, after that, there are no premiums. This may coordinate with your retirement, or not. In addition, cash value accumulation is much faster early on in the contract. If you get 3 or 4 years into it, and beyond, and run into trouble, you might be able to do an internal transaction, borrow the premium and pay it back when possible. The faster cash value accumulation makes that possible earlier in the contract than with conventional whole life. As always, get waiver of premium so that, if you're disabled, the premium is not waived. It is paid. And the cash value accumulation continues as if you're paying the premium. Whole life is a form of cash value life insurance where the cash value is guaranteed to equal the death benefit at the end of the policy term. Nowadays both the death benefit and the cash value exceed this because of the payment of dividends and excess interest credits. A 20-pay policy is designed to be paid up after 20 annual premiums. So, instead of paying for your whole life, you pay for 20 years.